Greetings, my name is Randy Helm. Today's topic is KPIs, or Key Performance Indicators. This is the second video in this series, and today we'll cover a few more KPIs that perhaps you could use in your business. If you missed the first video, there'll be a link to the video in the description down below. Now if you're ready, let's begin. In our last conversation, you told me about a few things that I could be using to help manage my business. Thanks for that, by the way. I am starting to track some of that. Glad I could help. I'm curious, are there more things that I could or should measure? I feel like I need a little more help managing things. Absolutely. What would you like to know? I want to know all of it. Well, how much time do you have? This could take a while. Well, just keep talking until I tell you to stop. Well, we can start with some liquidity ratios, then maybe go into some operational efficiency measures, and then we'll talk about. And of course, there are the customer surveys and the employee surveys as well. Wow, that's a lot. Where do I begin? We are going to cover several measurements today. Now, we can't go into all the possibilities, but I can give you a few things to think about. And for some of these, you may need your accountant to help you come up with these numbers, and that's okay. This is a higher level function than just paying the bills, so your accountant may actually get a kick out of doing some of this. Now, as I mentioned in the previous video, revenue is an important topic and comes up a lot. Here are some different ways to reflect that revenue. This gives you some options, different ways to think about it. With revenue, you can look at the progress towards your goal for the year or for the quarter. You can look at your revenue as a percentage of your goal, your target amount. If you're at 95% of target, you need to hit it a little harder. If you're 110% of your target, that's great. You're doing wonderful. And you could look at the percentage of prior year. If last year was a pretty good solid year and you're doing 105% of last year, great, you're on the right track. You can also have revenue compared to other information, such as revenue per labor hour, or revenue per head count, or revenue per some other measure. This is usually used when that other information is variable, scarce, or otherwise an important thing that you want to manage. You don't usually use this with a piece of information that is static, such as square feet of office space. Now, if you are managing several offices, square footage might be important. But if you're managing just one or a few locations, it likely is not going to be meaningful to incorporate this into your KPIs. When you're looking at revenue per labor hour or revenue per head count, these are somewhat compound metrics. They combine two things that you want to manage. For instance, the revenue per labor has both sales information and payroll information in one number. If the overall metric is not good, you can look at making tweaks to either number. By measuring revenue against your labor hours or headcount, you can determine if your staff levels are right, or if your employees are not providing the return that they should be. Now, it might seem callous for me to say this, but each employee is an investment in your company. Each one should be helping you move closer to your goal. There may be times when revenue per head count is too high. Times like this could lead to errors or upset customers, so watch out for that. And just like the revenue, gross profit is an often used number, and you can use the gross profit just like you can the revenue. Your gross profit actual towards your goal, your percentage of goal, percentage of prior year numbers. You can use your gross profit compared to that other information, such as gross profit per labor hour or gross profit per head count. Here are a couple of cash-related metrics. Cash on hand. This is pretty simple. This may not seem very exciting. If things are going well, then you might not need to look at this very often. But if cash is lower than you're comfortable with, this becomes very important. You want to make sure that you have enough on hand to meet your obligations, whether those are payroll, tax payments, utilities, or whatever. Cash conversion cycle. This is one that you may want your accountant to provide for you instead of you trying to figure it out yourself. Here is the basic formula. You take your time that inventory is sitting on the shelves in terms of days, and then you add the time it takes to collect money from customers if you sell an account. Then you subtract out the time it takes you to pay your vendors. Reducing your cash conversion cycle is usually a good thing, but caution. You need to be mindful of trying to extend your vendors too much. You need good relationships with your vendors. You can extend some vendors a little bit, but you may need to focus more on inventory levels and any receivables that you might have outstanding. Make sure that your customers are paying you timely. If your cash conversion cycle is high, then that means you can't put your money to good use, like improving your business or paying bonuses. When the cash conversion cycle is lower, you have a lot more options available to you. Closely related to these numbers is the cash flow solvency ratio. Again, have your accountant prepare this for you. Several metrics that we discuss probably should be prepared by your accountant. You just need a basic understanding of what it's trying to tell you. So why is this number important? It indicates how much flexibility you have as a company. A low figure can mean you're in danger of not meeting your financial obligations. If you are working with a bank to either get a loan or to increase your line of credit, this becomes very important. If you have a lot of money tied up in inventory or fixed assets, you cannot quickly access that value to pay your vendors or your employees or the bank. And this brings up a good point. There are several indicators that are similar in that they measure how quickly you can access your cash and pay your bills. These are often called liquidity ratios. The more liquid your company is, the more likely you will be able to continue paying your bills. Think of it like this. Each month, after you pay your personal bills such as rent or mortgage, utilities, food, etc., what you have left is discretionary income. If you put 100% of your discretionary income into a 401k or an IRA, you usually cannot access that until you retire. Now, if your car breaks down and you need a quick $2,000 to repair it, you cannot withdraw that from your retirement account. If you have money set aside in a normal savings account, however, then you can. This example illustrates why you need to pay attention to the liquidity of your company. You need to make sure you can pay for unexpected things that come up. A big one might be a dip in the market. If your revenue drops by 20% next month, will you still be able to pay your rent? By monitoring your liquidity levels, you will have a better understanding of your capabilities. Another example of a surprise that can pop up is storm damage. Sure, insurance might cover part of it, but usually you will have some out-of-pocket expenses that insurance will not cover. And perhaps you will have to close your business for a few weeks to do the repairs. Here are some liquidity metrics that you may want to consider. Current ratio, current assets divided by current liabilities. This measure compares cash and other short-term assets that you have with your outstanding short-term bills. Ideally, you would have a measure of at least 1.0. It assumes you can quickly convert your current assets into cash. Current assets such as inventory, accounts receivable, short-term investments. This is one that bankers use a lot. If you rely on a line of credit, you should consider adding this to the list of things you will track regularly. Days of working capital. Working capital divided by sales revenue per day. Now, working capital is the current assets minus the current liabilities. So this metric answers the question, how long can you go after paying your current liabilities? And a fairly safe number here to shoot for is about 30 days. If you have less than this, look at how you get money and how you spend it and see if you can make changes. If you have a lot more than 30 days, say maybe 120 days, perhaps you need to put your money in interest earning investments that still provide some liquidity in case you need it. These liquidity ratios may seem scary or alarmist, and I don't mean to scare you, but you should know at least annually what your numbers are. If they are low or borderline, you should probably be tracking those pretty regularly. Employee turnover. This measures how much you are losing employees. A higher ratio is often seen as bad. If your goal is to provide good customer service, you usually need good employees that stay for quite a while. This number can be a predictor of your performance. By tracking this over time, you can see how this relates to your customer satisfaction, your overhead expenses, and your overall profitability. Employee engagement. This is usually done by employee surveys. There are different companies that can facilitate this for you, and I do not suggest doing it yourself. Your employees may feel that their anonymity is not guaranteed and will not provide you with honest feedback. Customer satisfaction. This too is calculated using surveys. You can develop a multiple question survey for your customers to fill out. Have your customers rank the various criteria on a 5-star rating system. Keep in mind that anonymous surveys are much more accurate than if you know who is providing which rankings. Some people have a hard time telling you that your business is not performing well. It's sort of like saying your baby is ugly. I've stated this before, but there are hundreds of different things you can measure. These are just a small sample. When you start thinking about what you want to measure for your company, it should be meaningful to you. Don't just track something just because your friend is tracking it or because you heard me mention it on this channel. You want to think about what drives your business. What things have a huge impact on your success, or what dangers might mess things up for you. We will cover more on KPIs in future videos, so please stay tuned. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.